easy voting this time around. For the longest time, I had no clue what I was going to be talking about tonight because I think there was at least 3 of the topics that you guys submitted were at the top at one point or another. And we had a tie for a while, but it all came down to balancing your portfolio. So rebalancing. So we're talking a lot about rebalancing your portfolio. We're going to talk a little bit about stocks, how you should have them, a little bit about diversification. We're going to do all of that. In addition to that, we will also be taking any questions that you guys have. Now I can, and this is kind of this fun thing on these, because these are private videos. I have no clue. I don't even know if there's anybody here. Nobody, it doesn't tell me. It gives me a 0 viewers through this entire stream. So if you're here, definitely feel free to drop into chat, say hello, throw up your questions, all of that fun stuff. And we're going to get to the content here in just, of course, a moment. Before we do, just a huge thank you to the channel members, because I will tell you, you guys make a big difference to this channel. Absolutely. Every penny you guys have put into your channel membership goes a long way to make, to make what I do worth it, which is fantastic. All right. I do see the comments starting to pop up over there in the chat. So we're going to get to that. This is going to be just like a regular live stream, except for we do have, of course, our topic. So we're going to get to that here in a moment as well. First of all, let's quickly say hi to the folks I see in the chat. So a big hello to Paul. We got Mario in the house, and we have Wayne with a hello. Jackie's here. Awesome. It's great to see. It's great to see you guys. So throw your comments, throw your questions, throw whatever. These things, it's kind of funny. These channel member exclusive streams, they've gone anywhere from 30 minutes to I think the longest one's maybe an hour and 20. So it all really comes down to what you guys are doing. So we're going to talk about it now, because of course our topic is rebalancing. Let's talk about it. If you have rebalancing questions, definitely drop those in. Tell me about your strategies. And I see Paul has already sort of popped in there with, I just try to make holdings the same size. If one holding has a loss, I will not lower that one. Okay, fair enough. And we're going to talk about these things as well as we move along here. So first of all, one of the biggest strategies when it comes to actually managing your own portfolio, rebalancing is a huge strategy. It's really important. And we're going to talk a little bit about some do's and some don'ts, maybe some general tips. And we definitely have a few other things that we're going to bring up in regards to balancing your portfolio. So one of the things I usually say is a lot of times when you're balancing, one of the things that you want to keep in mind is you want to look at your overall risk profile, because that's what it really boils down to. If you're an investor who's wanting to take on a lot of risk, your balancing is going to be a little bit different than if you are a very conservative investor. So, for example, a conservative investor, for one, they're not going to have as many I don't want to call them wild stocks. They're not going to have a lot of those high dividend risk-filled stocks. They're going to have much more blue chip, much more those foundation stocks that I've talked about. So if you have a lot of foundation stocks, you're probably not going to need to rebalance as much as somebody, for example, who has a lot of riskier stocks, and they're kind of needing to shift things around as the market conditions change. And here's another little thing. We'll throw this in as well. So a lot of times people say, I want to have this percentage of this stock, this percentage of this stock. So let's just say, for example, let's say you had Microsoft and you're saying, I want to have 5% of Microsoft. Well, what happens when Microsoft goes up? All of a sudden, you may no longer have 5%. You may actually have 6% or 7%. So how do you handle that? Does that mean you need to go out and instantly sell some of your Microsoft, take those profits, reinvest them in something else to get things back into kilter? It might mean that, but it probably doesn't. And the reason it probably doesn't is that you kind of need to have a timetable when it comes to rebalancing. So you don't want to you don't want to be doing a weekly rebalance. That is not a good rule of thumb. I personally, I kind of like my rebalancing to be kind of in the quarters. So when the seasons change, I will usually do either a small rebalance or a larger rebalance depending on what I need. And that kind of is where that thumbnail came in today. You probably seen that half of it was winter, the other half was spring. That's to me is a good time. And you don't have to have, I mean, you can sort of create any rule that you want as to the time. But if you remember, and I've said this more than once on the channel, investing's like a bar of soap. The more you handle it, the less you have. So you kind of want to be a little bit careful. And there's other ways to rebalance. So I'll give you an example. For the longest time in my old TFSA, I was really, really overbalanced on Canoe. I had at one point, I had almost 10% of my entire portfolio was Canoe. And I wanted to get that down to 5%. But I also didn't want to sell any of my Canoe. So what I did is every single dividend that came in from Canoe did not go back into Canoe. It went into something else. I also put a freeze on Canoe. So I did not buy any Canoe. So as everything else was building up around Canoe, Canoe sort of organically fell. And, next thing you know, it was 8%. Then it was down to 6%. And so it moved that way by just not doing anything to it, sort of just leaving it be. So there's many different ways you can do a rebalance. Another thing too is when we're looking at rebalancing, some people will do something called a band. So you might say, okay, if I get outside of, so let's say you want 5%, you don't want any more than 5% in a stock. Well, what you might want to do is create sort of like a range, almost like if you guys are familiar with standard deviation. So standard deviation is when you hear somebody says, oh, well, I'm looking for something around 5 plus or minus 1. That would be your standard deviation. So if you had that with your stocks, that would mean as long as that stock was between 4 and 6, so plus 1 on either side of that 5%, you're happy with it. You don't have to worry so much about it. So some people do that as well. And it may not be, you may have a percentage amount. For example, if you're looking at, let's say you're looking at a sector. So if you are like me, I have this sort of loose rule that I don't like to have a sector above 20%. So I will probably have a 5% allowance. So, for another words, if I'm trying to keep it at 20%, I'm good as long as it's between 15, so 5 below, and 25, 5 above. I'll still try to bring it down to 20, but I'm not super concerned at that point. So that's kind of a neat little way to sort of approach things. So that is that's kind of one of those things. Now, the other thing too is you guys, if you're in your TFSA, this one probably doesn't count so much. But if you're doing investing outside of your TFSA, so in a personal account, another huge thing when it comes to rebalancing that you want to be considering is taxes. So for one, if you're taking a bunch of profits, you're creating, capital gains. And 50% in Canada, 50% of that amount will be taxable. So, when somebody says my taxable gain is 50%, it's not exactly the way it actually works. Basically, you still claim the whole amount, but only 50% of that is taxable. So 50% of the whole gain is taxable. And people just sort of kind of call that the capital gain right there. But that's cool. But here's the thing. When you're rebalancing, this is a chance to take a look at some stinkers. And we all have stinkers in our portfolio. But you can take a look at that stock that's doing really, really, really bad. And then you can say, is this a stock I have confidence in anymore? And even if you don't have confidence in it anymore, let's just say you don't want to pay taxes on these other gains. Well, in that case, you can take that stinker and say, okay, well, let's look for a different stock that has a lot more potential to gain back what I've lost on the stinker. So then what you're doing is when you sell the stinker, you're taking a loss. So perfect, you're taking a capital loss. And you can then levy that against your capital gain. So let's say on all of your good stocks, you have $1,000 in capital gains, but you've got this one stock that's down $1,000. You can sell that. You all of a sudden got a $1,000 loss. So you apply that against your $1,000 in gains and you're paying no taxes. And then you move that money to a different asset. So for example, let's say you were in, let's say Bank of Nova Scotia, so Scotiabank, and you're thinking, I'm going to take that as a loss, but I still want that bank exposure. Well, you can't just buy back Scotiabank because if you do it, it eliminates that capital loss right away. What you can do is you could then buy, let's say, Bank of Montreal, or or CIBC, or TD. You could buy any bank, and keeps your exposure. And when the banking sector does recover, those capital losses. See, here's the thing: the capital losses that you did get rid of, they're gone. But if you think about it, because you took that capital loss with Scotiabank and you just moved the investment over to another bank, when that bank comes back up and then gets back to where they were, let's say before they, back into the green from where the banks used to be, you have a bigger capital gain on that bank if you end up selling it. So you're not actually making taxes disappear. What you're doing is you're just shuffling your taxes around and you're saying, I don't want to pay this tax today, so I'm going to move this. And the beautiful thing, and this is what's great about investing, is when you decide to take some capital gains without tax loss harvesting to cover them off, you can always do that in a year when your income is down. So you can do that in a year when you have less income. So for example, after you've retired, that's one perfect example. It's kind of the same idea with the RRSP. You can take it then. So that way there, it makes the overall tax situation a little bit easier. So it's just one of those things to definitely keep in your mind when you're looking at rebalancing. So, definitely your tax implications. Diversity, of course, is another big consideration when you're coming to rebalance, because it's kind of a bit of a juggling game because you're trying to keep yourself diversified. And the reason you're being diversified, and you guys all know this, is for the simple reason you don't want to have too many eggs in the same basket. So that's, for example, I've had people say, well, why don't I just HMM.A is doing incredible. Why don't I just take all my money and throw it in HMM.A? Well, fantastic. You do that and you're probably going to make a ton, maybe. But what if something happens to HMM.A? What if all of a sudden the demand for transformers and related electrical equipment, what if that all of a sudden just drops off a cliff? Well, then there's no recourse. You're going to take that loss 100%. So that's the reason for diversification. We diversify as much as possible. So when you're doing a rebalance, you kind of want to be paying attention to how that diversification is starting to flesh out. And you also want to make sure that you're not doing a rebalance. Like sometimes if you're taking from, let's say you're taking from the energy sector, and you're throwing it into the banking sector, well, maybe you're already full in the banking sector with a lot of other banks. You probably maybe don't want to do that. You may want to move, for example, energy sector to energy sector, or maybe energy sector to utilities. Because it's kind of funny. Some people consider energy and utilities the same thing. I do separate them, but there's definitely a lot of similarities between them. All right. Let me catch up a little bit on these questions here, just because. You earned a dividend account RRSP amount. Okay, $20.68 for GRT.UN. That's not too bad. Mario says, I sold my 5% holding in KMP.UN with a nice profit. Nice. It never hurts to take a profit. I'll always say that. It never hurts. Lisa's in the house. Hello, Lisa. And here we go. We were talking about HMM.A is wild right now. Up again today. Yeah, HMM.A is just absolutely fantastic. And it's funny. I mean, it's actually hilarious. This is what I find really funny. I've been talking about HMM.A for almost a year. And I've been bringing them up over and over again. And then, of course, they exploded they've been doing fine. I mean, they'd actually been doing really good when I started talking about them, but nobody was yet paying attention to them. And now I go over onto Blossom, and I see HMM.A coming up all the time. And some people are like, "Oh yeah, no, this person and this person is starting to talk about it. It might be a good stock." And I'm just like, I've been talking about it for a year now. So, but yeah, HMM.A, I cannot praise it any more than I already have, I think. Paul says, if I have 4% in Costco and Costco goes down 50%, my portfolio would be down 2 ampersands. Well, there we go. That's the thing. Yeah, I mean, I think he means 25%. Yeah, that's the whole thing with diversification, right? You want to be kind of careful. Now, here's the other thing too. A company like Costco, they're blue chip. You know they're going to recover. So if a company like Costco goes down 50%, and that's not unreasonable. A lot of the tech companies did that at the beginning of the bull market. So if a company like that went down a big amount, you definitely do not want to sell. You want to be careful. Like for me to want to sell something that goes down, I'll do it for 2 reasons. One, if it's a tax loss harvesting situation. So that's like, moving from Scotiabank to CIBC. I'll do it for a reason like that. Or 2, the fundamentals no longer make sense. And there's a legitimate danger with that company. And because it does happen. There are companies that will go out of business. So don't sort of think that every company is safe. Even if we're moving into a bull market, companies can still go out of business in a bull market. There's a lot of different things that can happen. When we talk about black sheep events, usually we're talking about a black sheep event affecting the whole market, but you can have smaller black sheep events that might affect the sector. It might just affect a particular company. So definitely something to keep in mind. Paul says Wealthsimple can be set to drip, but when you see a dividend, you just cancel that drip order you see pending. Okay. That's cool. And you know what? And some people love drips, and I totally get that. And there's nothing wrong with dripping. Personally, I don't, because I use dividends as a way to, in a sense, it does help with my the fact that I only maybe do a rebalance every quarter. It helps with kind of like in between moving things in the right direction. Sort of like when I mentioned about Canoe, how I was taking all of those dividends I was getting from Canoe, and I would never put them back into Canoe because Canoe was over diversified. So, definitely something I do. All right. Vineet is in the house with a big hey. Hello there, Vineet. I think it's the first time to have my coffee. I won't praise Starbucks and try to get a sponsorship from them, only because they can't watch this unless they're a member, which would be very cool. Oh, coffee is goodness. Definitely. All right. So we're going to talk a little bit about some do's. So these are things that you should do. So one thing is your investment goals. Don't just rebalance your portfolio. Look at your actual investment goals. Look at your risk tolerance. Make sure that they are still the same. Make sure, for example, when you're younger, you will have a bigger risk tolerance than what you're going to have when you're getting closer to retirement. So it doesn't hurt to go over that as well. And I would look at that before you even think about rebalancing, because when things change, when situations change, when your financial situation changes, all of these things can impact risk tolerance. So, for example, if you got into a situation where all of a sudden your, let's say your job doesn't produce as much income as it used to, that can impact your risk. Whereas if you're making a lot of money, maybe you tend to be a little more risky because you can make up for any miscalculations if the risk goes wrong. But maybe if money is super, super tight, you can't do that. So definitely one of the big do's is take a look at your risks, take a look at your investment goals, because your financial situation, it is going to change over time. And that in itself will definitely necessitate adjustments to your to the way your asset to the way you're divvying out all those assets in your portfolio. So just something to keep in mind. Um, One other thing to do, and this is a do, is just like I wouldn't maybe I can't talk tonight. Just like I was mentioning with dividends. So I mentioned the whole thing with Canoe. Also look at your new contributions. So use your new contributions between. So between whenever you're doing your normal rebalancing, you can certainly use new contributions to, well, one, if you have a really good portfolio and you're happy with it too, you don't have to rebalance. Let's say, for example, if I normally do a rebalance every quarter and I'm coming up on a rebalance date and I'm looking at my portfolio and I'm happy with it. I'm happy with its performance. Maybe I don't touch a thing. That is perfectly fine because I will, of course, between rebalancings, I'm going to be putting new contributions. So, um, well, if you guys remember, when you watch the 0 to 100 TFSA challenge, at the end, when I do that little breakdown where I do the diversification by sector, that really does come into play is where I'm going to put the money next time with the next contributions. So I will look, for example, I think one of the recent ones I looked and I had very, very low in the real estate. And of course, I am getting bullish with REITs now. And I'm thinking with rate hikes coming, they're going to be doing pretty good the second half of the year. So I'm like, okay, well, I want to start increasing my exposure to real estate. So I use that as a tool. And instead of doing a rebalance, and maybe moving stuff out of one category over to real estate, I'll look at things when I do a rebalance. But for now, what I can do is that extra money coming in every month, I can allocate it to the sectors that get me a little bit closer to my normal diversification goal. And that's going to change. Like I said, for example, HMM.A, once again, they're just coming. I mean, it's just getting big. And as it gets bigger in my portfolio, it does start to throw a few things out of whack. So that's just one of those things I keep in mind. So definitely, consider using those new contributions for your rebalance. And that way there, you don't have to sell stuff off if you don't need a lot of rebalancing. So keep that in mind. Another thing is some people, if you don't want to do the math yourself, there are lots of different online tools and things like that you can use that can help you with rebalancing. If you're a passive income investor, I think Passive, Passiv, I think they have a lot of tools that you can use, for example. So that's just kind of the do's that are out there. I use and utilize whatever you can when it comes time to actually do a rebalance. Chad says HMM.A has lots of resistance at $14 though. Yes, it does. That has been a slight stumbling block. Like they've been hanging out in the $13.90 area. They've gotten close to 14, but they haven't broke it yet. Now, when they break that, that's going to be kind of interesting. I have a feeling the movement from 14 to 15 will probably be faster than the movement from 13.90 to 14. So we'll have to watch that and see how that works out. Prairie is in the house. Prairie. Prairie, you got your ENGH coming out tomorrow. Well, you can actually watch it now. So it is done. And it's I actually really loved that deep dive. I will say every so often I look at a stock and I'll look at like the 5-year on it or the 3-year, and I'll look at it and I'm like, oh, this is not going to be a good stock. And that's what ENGH was. I looked at it and I was not impressed, but I got into the fundamentals and, well, you'll have to watch the video, but the fundamentals changed my mind big time on this one. So I'm like, yeah, I think you'll be happy with that deep dive, Prairie, because you converted me. I'll give you that. All right. So we talked about the do's. Let's talk a little bit about don'ts when it comes to rebalancing your portfolio. One thing is a lot of people get tempted to do rebalances just based on market performance. And that's one of these things that when you have a lot of short-term fluctuations in the market, you don't want to be getting in there and saying, oh my God, things are out of kilter. It is time to rebalance. it is not time to rebalance. That's probably one of the worst times to rebalance, because what ends up happening is when you start responding to all of these short-term fluctuations, you end up creating a situation where you can end up creating an overexposure to some of your more high-risk assets, or you also in the process end up missing out on the rebounds, because a lot of these things that go down, they're coming back up. And that's one of the reasons when you sell when things are low, unless you're tax loss harvesting, or there's something fundamentally wrong with the company, it's going to turn around. It's going to come back up, and you don't want to be in a situation where you lose out on that. Like for example, look at Tesla. Tesla's a great example. Whether you love or hate Tesla, Tesla has this habit of rebounding. Every time people think it's down, and you'll see people saying, "Oh, Tesla's finally had it. They're not going to come back." And a lot of people bail, but they always do come back. So that does happen. And you don't want to be that investor who sells out of something because you're afraid, and all of a sudden it rebounds and you just watch it go up. Well, you've got some cash. Well, you've got less cash sitting in your account that could have been more cash. So just one of those things to sort of keep in mind when it comes to rebalancing and with some of those market fluctuations. The other thing, don't overlook your costs. So when you look, so for example, let's say if you're not in Wealthsimple, so if you're paying commissions on trades, you need to factor those in as well to your rebalancing. Also look at things like if you've ever seen a bid-ask spread. So when you go to actually purchase something, you will get a little bit of a spread on it. So there'll be a bid and there'll be an ask. Actually, let me show you. Let me see if I can show you one here. Give me a second. I'm going to pull up. Oh, I know where it is. It is on, it's on this one here. But here, all right. Give me a second here. We will. I'm just going to present my screen. Didn't actually plan to pull anything up, so let's go here. All right, there we go. There we go. All right, so now I'm in stereo because you can probably see two of me, but that's fine. I am going to, oh wow, this is getting freaky. We're starting to create that tunnel thing. Oh God. All right. I'm going to cover me here in a second. Oh yeah. Let's bring this over and we'll cover everything there like that. All right. So what I want to show you is, all right. So this here is just a quick little sale I get going on. But when I click on buy, well, I have to sign in. Well, let's do it. All right. Monday, the market's closed in both Canada and the US. All right. So let's click on buy. So you'll see here, you've got right here, this here is your bid ask spread. So in this case here, the bid is $9.98 and the ask is $10.03. So what that means is if I'm buying it, chances are I'm going to be paying $10.03. If I'm selling it, I'm going to get $9.98. So basically, when you look at it, whichever number is the worst number for you, that's the one you're probably getting. So once again, what that means is when I am going to rebuy another asset to put into this whole thing, I need to be aware of this bid-ask spread because it's really important. So a lot of times, and this is why I say, I've had people when they're just buying stocks regularly, they're like, oh, I thought it was $9.98 and they charged me $10.03. What's going on? Well, what you can do here is let's say you're buying 100, come down here, throw in a limit price, and let's say you want to pay $9.98. So you're going to do that. You'll hit the submit. I'm not going to do it right now because I don't want to put this in. For one, it would put me into a negative anyway, but it's fine. But what would happen here is that even though right now there's none available at $9.98, this will sit here, and if this price goes down a little bit, once it hits 998, it's going to trigger your buy, and you're going to have that. So you're going to be good that way. So that's just kind of a neat thing. Now, another thing that you can do here, and a lot of people don't do this, let's go to a sell. So let's say if I want to sell this, if it gets to a certain amount. So in a case like that, I'm going to use a stop loss. I know we're on a tangent. Who cares? So with a stop loss, so let's say this is at 998, but I'm thinking to myself, well, if it falls below 995, I want to get out. So if I just do that, 995, and you'll notice here there's a trigger price and then there's a limit price. And the reason the limit price is there, and I would actually put in what's the lowest I'm willing to sell for? So even though I want to get it at 995, I might say 994. Because what sometimes happens is sometimes an asset, when it's falling, it might skip over the 995. It may just jump. It may be or it may just move so fast that I can only sell like maybe 5 or 10 of them at 995. And then it falls down to 994. Now, if I have it set up this way with that as a limit price, I'll still sell the rest at 994. But if I don't, if it were, now in this situation here, if, for example, it really fell, it could completely jump over both of these. Now, normally when I set it up, when I'm doing swing trading, I actually normally would actually use that as a 3. So 993, that's kind of the reason I would use that. But all right, let's pull this all back here. Now that we're no longer in a tangent, and I need to get that other thing out of there. Let's, oh, there we go. I'll just remove that. All right, we'll pull this here back over. Oh, wow. There we go. Everything is now in the right spot. Perfect. Okay. Let's get to, let's see. Prairie says, good evening, everyone. Just got home from work. Thought the stream started later for some reason. Watching at 1.25x to catch up. All right. I should try to talk 1.25% slower. No, I'm just kidding. Wayne says, gonna take 1/8 on my portfolio. Thanks. Yeah, I mean, I'm looking at them. It's kind of one of those things, like when I looked at the fundamentals, for one, I was surprised that they didn't bounce back, but they've got all of the right ingredients. So they definitely have all the right ingredients. Paul says, have YouTube Premium. I guess live streams cannot listen in the background. Yeah, I'm not sure how that works. Oh, well, Paul is off to physio. Bye. Well, have a good workout. Have a good workout, Paul. All right. Now, the other big don't when it comes to rebalancing your portfolio, and I've mentioned this before, don't do it too frequently. I mean, if it's not broke, don't fix it. Don't touch it. We're going right back to the whole bar of soap thing. Investing is like a bar of soap. The more you handle it, the less you have. And that is so true, especially if you're in a situation where, let's say you have commissions. If there are commissions on all of your trades and you're doing a whole bunch of trades, you're just losing money. So you don't want to be doing that. And also, the whole thing that you're doing is, let me grab a cup of coffee here for a second. So one of the whole objects is you want to be able to catch, you want to be able to catch all your waves up. So you don't want to get caught in that being stuck in the trough and panicking. And so many people do that, but you don't have to do that. Be informed, have a plan. And that's a big thing. If you have a plan, quite literally, it prevents you from getting suckered in by HUD. So, FUD, by FUD and FOMO. So if you have a plan, like for example, I'll use swing trading for an example. I usually have a plan. If I don't have a plan, then, I'm going to, if something moves in the wrong direction, I'm going to either get, fearful and maybe make a bad move, or maybe something, you don't want to be buying at the top, unless, and I'm going to put this here. One of the interesting things is that as we move into a sustained bull market, a lot of people are like, well, I hate to buy something at an all-time high. Well, if we're going to go into, let's say we went into a bull market and we won't know how long it's going to last, right? But if it's a 2-year bull market, and sometimes bull markets can get pretty lengthy, um, you're going to be buying at all-time highs because, the all-time highs at the beginning of the bear market would be massive crash areas for the end of the bear market. So it's kind of one of those things to keep in mind, that it's okay to buy at an all-time high, but if you do, you want to make sure that you're going to diamond hand that to the next all-time high, and that if it has a correction after you buy it, and sometimes that happens, it's that bad luck that comes sometimes with investing. It's like you buy it and it goes and falls. Well, you don't want to be that person who's like and sell it right away. So that's never never a good practice for sure. All right. Let's see who else is here. We got Trevor. Trevor's in the house. Late, but here. Welcome, welcome. Jill says, yeah, members only live streams. You can't minimize and listen in the background. That's right. I think Jill mentioned that to me a while back. So, it's kind of one of those interesting things. Now, the regular live streams you can, but these ones, for some reason, you can't. And hopefully YouTube fixes that, because I'd like people to have that option. Now, the other one benefit is I don't monetize these, because you guys are paying channel memberships. Why am I going to charge? Why am I going to make you watch ads too? So, for people like, well, I didn't see Vic here, but if Vic were here, he wouldn't have to watch his 90 minutes of commercials for this one. So that's kind of, or sorry, 90 seconds. I heard Jill yelling in the back room, 90 minutes. Now, mind you, I remember back in the olden days of YouTube, I got hit with these commercials that I could not get out of. Going in to watch a video where I would get a 30-minute commercial at the beginning of it, almost like a documentary for some weird company. But I would be like, oh my God, there's no way out of it. Other than I could leave and then go back in the video and it would start me at the beginning of it again. I was like, no, why does this happen to me? But it does. It happens. So, what can you do? Yeah. So when it comes to taking profits, for example, there's nothing you can really do about those capital gains unless you're tax loss harvesting. But a lot of times you're taking those capital gains and you're not exactly planning to pull that cash out of your investment portfolio. You're going to just reinvest them. So that's another opportunity. So when you're doing that, and usually in the whole process of reinvesting, that's what happens. You take a little bit off the top, and you want to put it in areas that perhaps are under diversified. Now, keep in mind, when I say, when I talk about my diversification, and I talk about that whole 20%, there's more, if I tried to put 20% in every sector, I would run out of sectors very fast. So for me, that's just more of a maximum. So here's that thing. A lot of times, if you look at my portfolio and you look at the ones where I'm up around 20%, it's usually because there's a reason I've let that get up a little bit higher. One of the reasons with the bank, so I think my financial sector is up there. That's simply because I've been stacking up a little bit on, like on Scotiabank and some other banks, just to get some dividends flowing while they have the higher yields. So those are ones I will let them just fall down by not investing in them. I'll just be investing in other things to pull it up. So there's reasons that you will get out of your normal chain very, very easily. So that does happen. Just something to keep in mind. Now, some people, and let me put this other thing here. Some people are like, okay, well, I have my diversification for my TFSA. I got a different diversification for my RRSP. Oh, and I got crypto, and I got this, that, and everything. Well, really, if you want to do diversification, you probably should do it for your entire portfolio, right across all your accounts. So, for example, if you've got, if you got a whole bunch of HMM.A in your DFSA, and then you look over at your RRSP and you're like, oh, well, I got to make sure I have a good amount of HMM.A over there as well. That all should be added together. So you should do a bigger picture. That way there, you're looking at your full diversification across, across your entire portfolio. Because, in the end game, so when you're retired, it all comes into play. Just one of those little things just sort of to keep in mind. The other big thing when it comes to diversification, and this is something that doesn't even involve touching your stocks, you want to pay attention to the news. That is huge. So you want to stay basically informed about what's happening with the companies that you own, what's happening with the economy, changes to taxes, for example. All of these things can come in and play some point or some aspect when it comes to your overall portfolio. So that's another good thing to keep in mind. So you want to stay on top. Luckily we have this week, so that's one way that you can certainly do that, because I do pull a lot of the major stuff together. But if you're invested in stock A, B, and C, I may not cover A, B, and C, so you still want to be paying attention. Now, actually, okay, I'm just going to do it that way. I'm going to bring up my screen here again. There we go. So with this one here, so this is the 0 to 100K companies. So for example, when I look at Alvo Petro right here, this one is great because I get my news right below it. So the latest news I have from Alvo Petro was February 5th, just talking about them providing some of their sales volumes and their semi-annual natural gas price update. And I can sort of scroll through and I get all kinds of updates on them. So Alimentation Couche-Tard, last thing that came out news-wise, February 7th, some stuff came out. So stuff on prices of private offerings. Let's see. There's a Couche-Tard brief. And here's a big press release. Let's see. Prices, private offerings of U.S. So these are just things you can go into. And so, for example, let's say, I wanted to look at this price release. I can just click on it, and I'll bring it all up here. So this will bring up all of the information that I want to go through. So it does this for everything. So this is one of the things I really like about, this is TradingView. So TradingView is pretty darn good that way. And here's CNR. CNR's been tearing it up lately. And let's see. Here's the first thing right here. North American Freight Railroad traffic rises again. Interesting. And look at what's been happening with CNR. They've been on this nice big upward move. CN sustainability leadership recognized. So yeah, it's just all of this news. It is fantastic. You can sort of look through the whole thing. Now, when I get back to, I'm going to come over here. Here's the good old Bitcoin. The Bitcoin one, I find there's so much news. Like, look at this. The last piece of news they got was 12 minutes ago. BlackRock's Bitcoin ETF holdings near 110K of Bitcoin. So there we go. A little bit of information that comes in there. Did Elizabeth Warren just endorse Bitcoin? Not so fast. Yeah. So you have to kind of read some of them. I find with Bitcoin news, you have to really look at it and look at the source, because there's a lot of hype out there and there's a lot of Bitcoin propaganda. So you have to really sort of look at it. I know somewhere today I seen something about Berkshire Hathaway having Bitcoin, and I haven't seen it anywhere else. So I don't know if it's true or not. I have to actually go digging on that one, because that would be a pretty big story if it's the case. That would also be very, very bullish for, of course, Bitcoin in that situation as well. So not a bad thing here. But look at the TSX today, guys. Another nice green day, up 1.60%. So gotta love that. And here's kind of the neat things. If I put the actual exchanges in here on TradingView, it actually will give me, like, look at this. Here's an article on the S&P TSX. Basically ends 1.6% higher. TSX posts its biggest gain in 2 months as resource shares jump. So not bad. So you can get stuff on everything. Here's the US dollar. And, most of the stuff is kind of like, there's a lot of, I don't want to call it crap, but things that you may look at and be like, okay, it's not that relevant. But it is a good way to get, if I want to look at gold, So here, gold prices bounce off confluence support, markets I, US PPI. So PPI, that by the way comes out, I think that's tomorrow. So just one of those things to keep in mind. So there's all kinds of great news. This is like I said, if you haven't tried TradingView, give it a whirl. There's like the free version gives you most of this. Basically, the paid version, the difference between I think the non-paid version and the paid version is one, I get more indicators that I can put in there. I'm going to go back here to Bitcoin for the moment. I get more indicators. So things like if I want to create lines and supports and things like that. I also get up-to-date prices. So when the market's live, well, Bitcoin's live right now, and you can see right now, see 52.14, it just changed. So I get up to the second pricing. And when I'm doing trading, that becomes huge. So yeah, and you can see as well, things like gold. The price of gold will change through the night. WTI will change. The US dollar, of course, that will change as well. So anyway, that is just a little bit of trading view for you guys to take a gander at. I'll get rid of this. We'll bring back my big head again. And yeah, exactly what Chad says. With crypto, it never sleeps. Trades 24/7. So the news has to try and keep up. Yeah, and they do. They do, absolutely. You know, and sometimes as well, I can get some interesting feelings for how the sentiment is going with, for example, Bitcoin. So just one of those things to keep in mind. Okay, guys, we're coming up towards the end. If you guys have any burning questions, now's the time. Throw them in. They don't have to be about rebalancing. They can be about anything in the world. You guys are the channel members. You guys sort of decide. I will mention we are coming up towards the channel members choice video. So the last video of every month, you guys get to choose what it is. I will ask you guys for suggestions that we can vote on. Now, here's one suggestion I'm going to give you guys is that this is your opportunity to get videos outside of the norm. So the last channels members video, you know, you guys had me basically do something I would do in a normal thing. So it was like I think it was the moats, you know, Canada and US moats. So I split that into two videos for you. But, you know, this is the opportunity, especially if you want some of these tutorial videos or you want a more research-oriented or a more educational-oriented video, perfect timing to get those in. So I always say, go outside of the normal box. Like, don't ask me to do a list video because I always do list videos. You guys can get list videos, no problem. I mean, if you ask for a list video, I'm still going to put it up for the vote. And if it wins the vote, I will still do it. I'm just saying this is your opportunity to get, you know, things outside of the norm. So that's just one of these things. When I ask, just throw in whatever you want. You know, as long as I have 5 options that you guys can vote on, that will be fantastic. All right. Well, anyway, this has been another one of these fun channel member live streams. Here we go. Before, I was about to say goodbye, but here we have something from Change to Spare. I'm coming up against some big life costs in the near future. My car is dying, and some home improvements are about to force me to dip into my TFSA position. Do you or others do that? Absolutely. Absolutely. In this last year, I had some really big expenses. So we dipped into the TFSA here, and you have to sometimes do that. That's one of those things. Sometimes you have no choice. Now, the beautiful thing is, though, keep in mind, when you do dip into your TFSA, you will get that contribution room back in, well, January 1st. So you get your contribution room back. So that's a good thing. So you can make back up, you know, you can rebuild your TFSA. Not a big issue. But yeah, sometimes you have no choice. So in this case here, you know, especially if you're in a situation where you absolutely need your car for work, it's essential. Then absolutely I would dip into your TFSA. Don't dip into your RRSP because you will have tax consequences for doing that. You will, for example, if you want to pull something out of your TFSA, most institutions are going to, first of all, hit you with 15% withholding tax that they will send off to the CRA. You can get that back at tax time, well, unless you've made too much money. But there's all kinds of tax implications in that matter. So your TFSA, no implications. Just pull it out. It doesn't matter when. Just remember that room is gone until January 1st. That's the big thing in there. Or do you hold cash in other accounts? Here's the thing about holding cash. Most accounts aren't going to pay you that much. Like if I was holding cash, I would probably hold it in one of the cash ETFs. For example, cash. So at least that way there, you're getting a 5% return on it, and you can pull that out and liquidate it pretty quickly. So that's one of those areas that I would look at. The only thing to keep in mind, though, is that with something like that, where if you're using a cash ETF, let's say you had it at Wealthsimple, you could sell those. You could sell that ETF, pull out the cash that you want, but it probably is going to take you a few days. I think about 3 days to get that money out of Wealthsimple. You might get it a bit sooner. I think they're moving faster. I think the last time I moved something out of Wealthsimple, it was like 2 days. But that's just because of the way clearinghouses work. And now that Wealthsimple, I think they have better relationships now, so they're a little bit more efficient. But that's just one of those things to keep in mind. If you need something for absolute emergencies, that's where credit cards kind of come in. You can use a credit card, and then, if you need it immediately, while you're pulling your money out of, let's say, your TFSA and then transferring it, then dump that on your credit card so you don't have to pay any interest on it. If you want to pay the interest, you're more than welcome to, but, just one of those things to sort of keep in mind. Chad says, so if I have BNS in my TFSA, I can sell and, let's say, buy TD without penalty, just as long as it's not the same company shares. Yeah, exactly. The rule in your TFSA is that you can't buy back the same thing you sell within 30 days. So I always say don't count to 30, count at least to 31, just to be on the safe side. But if you're moving it to, like, if you take it out of BNS and move it over to TD, no problem. But also keep in mind that you don't have to do any kind of that fancy tax loss harvesting in your TFSA because, it's tax-free. All right. And Chad says, and with the RESP account, if your kid don't go to school, what happens to the funds? They get taxed. So what ends up happening is a couple of things happens. If your child doesn't go to school and that's funds coming back, the money that the government put into it, that money will go away. So you'll have to pay that back to the government. They'll take it. So you'll lose any grants that were given, and then anything that you pull out would then be considered taxable income. So just something to keep in mind with that. And Chad says, yeah, buy cash ETF, earn 5.02%. Always keep a bit of cash for the dips. And there we go. And Chad's verifying 72 hours holding last time for him. So one of those things to keep in mind. All right. Well, this has been another good one. I've had fun. Hopefully you guys have had fun. We got a video dropping tomorrow, but you guys can watch it now because you are channel members. We do have another live stream coming up on Sunday. So I think that is going to be pretty darn okay. Or pretty darn cool. We don't have to worry about football. Actually, I figure I'm going to have a lot of people show up on Sunday because I'm not competing against the Super Bowl this time. So yeah, I look forward to seeing you guys all there on Sunday. Until then, take care. We'll see you all again really, really soon. Bye, everybody.